Good day everyone. So today we will be discussing the vertical and horizontal analysis of financial statements and limitation of financial statements. So to start with, vertical and horizontal analysis are two techniques used to analyze financial statements. Vertical analysis involves comparing different items within a single financial statement. It expresses each item as a percentage or base amount, such as total assets or net sales. This allows for a better understanding of the composition and relative importance of different components of financial statement. For example, vertical analysis of an income statement can help identify the proportion of sales revenue that is allocated to the various expenses. So, horizontal analysis, on the other hand, involves comparing financial statement data over a period of time. It helps to identify trends and changes in financial performance over time. By comparing the line items from multiple periods, such as comparing revenue from one year to the next, analysts can assess the growth or decline of a company's financial performance. So that's the difference between horizontal analysis and vertical analysis. While vertical and horizontal analysis provide valuable insights into a company's financial health, it is important to be aware of their limitations. Here are few limitations of financial statements. So, number 1, historical nature. Financial statements are based on past transactions and events. They may not reflect the current market conditions or future expectations. Number 2 is subjectivity. Financial statements involve judgments and estimates such as the valuation of assets or recognition of revenue. These subjective elements can impact the accuracy and reliability of the financial statements. Number 3, the limited scope. Financial statements provide a summary of financial information but may not capture all relevant aspects of a company's operations. Non-financial factors such as management quality or market reputation are not reflected in the financial statements. So the next one is the number 4, lack of comparability. Financial statements of different companies may not be directly comparable due to variations in accounting policies and practices. This can make it challenging to assess and compare the financial performance of different companies. The last one is the potential manipulation. Financial statements can be manipulated or misinterpreted, leading to inaccurate or misleading information. This highlights the importance of conducting a thorough analysis and considering additional sources of information. So, it is essential to consider these limitations and use financial statements in conjunction with other sources of information to make informed decisions.
So what is the difference between vertical and horizontal analysis of financial statements? Vertical and horizontal analysis are two different techniques used to analyze financial statements. Here's a breakdown of the differences between the two. Definition: vertical analysis. This technique involves comparing different items within a single financial statement. It expresses each item as a percentage of a base amount, such as total assets or net sales. Horizontal analysis. These techniques involve comparing financial statement data over a period of time. It helps identify trends and changes in financial performance over time by comparing line items from multiple periods. Focus. Vertical analysis. It focuses on the composition and relative importance of different components within a financial statement. It helps understand the proportion of each item in relation to a base amount. Horizontal analysis. It focuses on the changes and trends in financial statement data over time. It helps assess the growth or decline of a company's financial performance. Comparison. Vertical analysis. It compares items within a single financial statement. For example, It compares each expense item as a percentage of net sales or each asset item as a percentage of total assets. Horizontal analysis. It compares financial statement data over multiple periods. For example, it compares revenue from one year to the next or compares the balance of an asset at the beginning and end of a period. Purpose. Vertical analysis. It helps understand the structure and composition of a financial statement. It allows for a better understanding of the relative importance of different components. Horizontal analysis. It helps identify trends and changes in financial performance over time. It provides insights into the growth or decline of a company's financials. So, both vertical and horizontal analysis are valuable techniques for analyzing financial statements. Vertical analysis provides insights into the composition of a financial statement, while horizontal analysis helps identify trends and changes over time. By using both techniques, analysis can gain a comprehensive understanding of a company's financial performance.
Limitations of financial statement and analysis. Number 1, based on historical data. Number 2, interim report are produced. Number 3, based on personal judgment. Number 4, not always comparable across companies. Number 5, false figure. Number 6, figure are distorted. Number 7, price level changes not considered. 8, non-monetary data ignored. Based on historical data, financial statements do not disclose the current worth of the company. Initially, we record transactions at their cost. The value of asset and liability changes over time. Financial statements relying on historical data capture transactions at their original cost. They don't reflect the current value of a company as the worth of asset and liabilities evolve over time. Interim reports are produced. Financial statements are interim reports, thus these are not final reports. Therefore, a user can gain an incorrect view of financial results by only looking at one report period. Interim reports being provisional financial statements are not final. Relying solely on one reporting period can lead an inaccurate understanding of a company's financial performance. Not always comparable across companies. If a company wants to compare the result of its company with different companies, their financial statements are not always comparable because different companies use different accounting practices. Comparing financial statements across companies can be challenging due to varying account practices adopted by different companies, making the result not always directly comparable.
Personal judgment. The value of assets that appear in the statement depends on the standards of the person who deals with it. False figure. The management team of a company may skew the results. This situation arises when there is undue pressure to report excellent results, such as when a bonus plan calls for payouts only if the sales level increases. Figures are distorted. Financial statements provide information about either historical results or financial status of a business of a specific date. These statements do not provide any value in predicting what will happen in the future. Price level changes not considered. Financial analysis does not take into account any changes related to the price level. This may render the analysis of financial statement less useful. Non-monetary data ignored. Monetary information alone is considered in financial analysis, while non-monetary aspects are ignored.
To calculate vertical and horizontal analysis, you will need the financial statements of a company, such as the income statement or balance sheet, for multiple periods. Here's a step-by-step guide on how to calculate each analysis. Vertical analysis. First is choose the base amount. Select a base amount to which all other items will be compared. Common base amounts include total assets for the balance sheet and net sales for the income statement. Second, Calculate the percentage. Divide each line items on the financial statement by the base amount and multiple by 100 to get the percentage. This will show the proportion of each items relative to base amount. And lastly, prepare the vertical analysis. Create a vertical analysis table or column where you list each line item and its corresponding percentage. Horizontal analysis. The first step is select the periods. Choose the periods you want to compare, such as year over year or quarter over quarter. Gather the financial statements for each period. Second, calculate the difference. Subtract the value of each line item in the earlier period from the value of the same line item in the year later period. This will give you the difference in value between the two periods. The third step is calculate the percentage change. Divide the difference by the value in the earlier period and multiply by 100 to get the percentage change. This will show the percentage increase or decrease in each line item over time. And lastly, prepare the horizontal analysis. Create a horizontal analysis table or column where you list each line item and its corresponding percentage change. So, vertical analysis compares item within a single financial statement, while horizontal analysis compares financial statement data over multiple periods. This analysis provides insights into the structure, composition, and trends in a community financial statement. It is important to note that the specific calculations may vary depending on the financial statement and the requirements of the analysis.
Hello, I'm Chair Dimain. Today, I'll be presenting this vertical analysis. As you can see, I have the 2014 and 2013 amounts they have in each of these categories here and I'm primarily taking a look at the assets here that for this portion of the problem we're going to work on now. You will many times do this with the whole balance sheet and take a look at the vertical analysis of the whole balance sheet, but I'm going to take a snapshot of just looking at the asset that we have and see will we have some changes from year to year and what percentage of the total assets they are. So that's what we'll take a look at here. So to start with, what I want to figure out is some percentage here and we're going to pick out the percentage of what these are. So I'm going to start with 2013 and then move my way over to 2014. So as you can see, we're going to take a look at current asset now. And current assets in 2013 had the 400,000 divided by 1.6 million. So what I do to figure out what the percentage of the current assets are of the total assets, because that's what we are doing in vertical analysis here, is what percentage of this is of the whole thing. So I have 400,000 by the 1.6 million. So I also figure that out, which will give me a 0.25 or 25%. So that's my percentage. There I will do that for each and every one of these here. So I'll take the 200,000 and divided by the 1.6 million, and which gives me a 12 12.5%. So, and then the 800 divided by 800,000 divided by 1.6 million. So, which will give me a 50%. And then finally, the last one here, which is 200,000 divided by 1.6 million, which would give me 12.5%. Adding all this together, I should come up with 100%. And so now I figure out each of these. Here I'm going to do 2014. Then we'll take a look at the numbers and analyze those. So on this one here, the current asset is 500,000 out of the 2 million. So which is also 25%. Same as it was right previously in this. On here I have long-term investment, and while it went down to 100,000 divided by 2 million. So there's been a change there. So it's now 5%. It's now 5% to figure out that was 100 over the 2 million. That's how I calculate that. So you take that number over the total asset that we have. Then we have the 1 million divided by 2 million. Here, so that is 50%. 50%, and again whatever it is. So if I have a current asset, write this up here over total asset, whichever we're looking at there, and that's how figure out each of those. So lastly, we have 400,000 divided by 2 million, which is 20%. If I had all those together, that's 30%, that's 50, so that's 80, and the total of 100%. Total equal, okay, so now we figure out what each of the categories are and what the percentage they are of the total assets. Now we can begin to analyze some of this here. So as I take a look at this here, you can see that the current assets, well, it's the same, so I'm not going to all the changes. My addition to my total assets, it went up from 1.6 million to 2 million. I have an increase and increase in the same way for between 2013 and 2014 for my current assets. Now, some of the changes were in my long-term investment. I went to 5% to 12.5. That changes there could be for several different reasons, but we want to look at these things and see we're doing the right things. Here we've reduced our long-term investment. We've also here you can see that the same thing is happen with our plant property equipment, um, that has changed the same. It's the same percentage, which is 50%. So you can still see that. So we haven't taken some of this to put into here as much. We take it in to put our intangible assets now. Maybe it's because we taken an investment and decided to our long-term investment and invest in something a little different, and maybe that's an intangible asset. We bought a portion of a patent or something like that, and that is what we're going to use to move forward. So we've increased 12 12.5% and to 20% and reduce a long-term investment down by that. So we may have decided to buy a patent, or maybe it's something else that we decide to buy, but to advance our company. That example company now, this is just some of the things that could have happened, but we're looking at the numbers here, and then we want to look at reason why this changed, if they are good thing that they change, for maybe if it's not good thing, that we need to take a look and see where the issues maybe that might have caused that this is. So this is the vertical analysis. Today I'll be showing you some brief information about the horizontal analysis and how it's used in companies, and then how to calculate it. So as you can see here, I've taken the balance sheet, was focused it a little more on one specific area, which is a current asset. So I have 4 different accounts than my total current assets. So as you can see here, there's 2013 values and my 2014 values. There's been the change in those values, and so here what I will have is each of these there's been a decrease or an increase, and we'll figure out what those are, and then we'll figure out the percent of change against that. So let's first compute the difference in each of the categories. They're in the counts that we have, and then we will figure out the percentage of increase and decrease, and I'll walk you through that. So if we look here in 2013, we had a change from 8,000 to 12,000. 2014, so we had a 4,000 increase. And then for my accounts receivable, as you can see here, we had an 8,000 balance in 2013, and then we went to a 6,000 balance in 2014. So we dropped 2,000, and then we supply 1,000, and then in my supplies I went from 6,000 2013 to 4,000 2014. So again had a 2,000 decrease, and this one decrease, and then finally in my inventory here I went from 25,000 down to 20,000, which is a 5,000 decrease. So I had 1 increase and 3 decrease. There now my total current assets was 45,000 in 2013, then it went to 42,000. So I had a 3,000 decrease. And so that's how you compute those decrease and increase, basically just taking the base year and the difference between the base year Then the next year now we're going to calculate the increase or decrease percentage. To figure that out, I'm going to take the first one, cash, here, and what it shows me an increase of 4,000. So 4,000, I take my 4,000 here over my base. Remember, always use the base year so that so that so that you are basing it off. So this is one we are basing it off of 2013, and so my increase would be it's 0.5, which is 50%. 50%, so that is my increase in my cash account from 2013 and 2014. So remember that you use the base year, so the year that you're starting with for the increase or decrease. So I have do the next one here is 2000 decrease, and I have 8,000. 8,000 was my base, so therefore I will be 0.25, which is 25% decrease. And so that what I'll have here, and so here on this one for my supplies, I have 2,000 decrease, and once again, but it's over the 6,000. So that gives me 33, which is 33.3% decrease. There, and then finally in my inventory here, last one of the accounts, and we also do the current total current assets, but I have 5,000 decrease, and that is over the 25,000 base here, and that gives me a total of negative 20. So I will have a 20%. I don't need to put in there since that's already negative, and put the percentage, and the final thing we'll do is the total current assets, which is my 3,000 decrease, and over the 45,000, then divide it, and now I put in the calculator. It will see how it will come out to be 67%. That would be a negative because this was a negative here. Let me over some of the things that why company will use this well. We want to see some of the changes here and there in their out what is the reason of these changes. Obviously with the 50% increase and cash now, why do we have that 50% increase in cash that we will be found in your statement, the cash flows? What was those things that made those changes, which could be the financing, investing, or your operation? And so that's some of the areas you look at. See that one of the things here is you can see we have a reducing account receivable, and so we are doing a little better about collecting the money that is owed to us. That is good, positive thing. And then supplies looks like we have a decrease in that. There may be a reason because maybe we're not purchasing many supplies as we had in the past, and we're using more efficiently. And then maybe inventory some things here, maybe we're moving towards adjusting time, or we're just reducing our inventory before the end of the year, so we're reducing some of those things. And maybe our total asset is a little higher. Those are some of the things that we look at, is where are the changes from year to year, and how are we doing in those type of areas there. So this is just a snapshot of one portion. If you do these times with your income statement, and then also with the full balance sheet with all everything there. Thank you.
Vertical analysis. Vertical analysis helps identify changes in the composition and relative importance of different components within a financial statement by expressing each line item as a percentage of a base amount, such as net sales or total assets. Vertical analysis allows for a better understanding of the proportion and significance of each item. By comparing the vertical analysis of a financial statement over multiple periods, you can identify any significant shifts in the composition of the statement. For example, an increase in the percentage of operating expenses relative to net sales may indicate higher cost structures or inefficiencies. Conversely, a decrease in the percentage of liabilities to total assets may suggest improved financial stability. Horizontal analysis. Horizontal analysis focuses on comparing financial statement data over multiple periods to identify trends and changes. By calculating the percentage change in each line item from one period to another, horizontal analysis helps assess the growth or decline of a company's financial performance. By examining the horizontal analysis, you can identify patterns and trends in financial performance over time. For instance, consistent increases in revenue year after year may indicate a growing customer base or successful marketing strategies. Conversely, a decline in profitability over several periods may signal operational challenges or changes in market conditions. So both vertical and horizontal analysis provide valuable insights into a company's financial performance over time. They help identify changes in the composition, proportions, and trends within financial statements, allowing for a comprehensive assessment of a company's financial health and performance. These analyses can aid in decision making, strategic planning, and evaluating the effectiveness of financial management strategies.